Mark, the Dow's above 13,000 and the NASDAQ's above 3,000. Where's the market going and where do we end in 2012?
Well, we all hope higher. I think that I'm a little concerned at this point that we might have front-loaded calendar 2012's returns. When you consider that we're up 12% plus on the Russell or the S&P, I think we're finding it very challenging to put money to work at this point.
How do you invest in this type of environment? What's your strategy?
Well, our strategy is the same regardless of the environment. We're bottom-up stock pickers, and we're trying to find a discount from private market values to where the market trades today. In essence, we want to buy $1 for 80 cents if we can, using a conservative estimate of that value. So we always are looking for what I call basic boring businesses, things that people need and use, beer, shoes, underwear, decidedly unsexy businesses that generate attractive returns for long-term holders.
Using private valuation techniques, how does that, if a company isn't going up for sale, how do you find the opportunities there? How do you realize the opportunity, I guess?
That's a great question. I think that the challenges of any valuation-sensitive investor like we are is to end up in what we call a value trap, where there's obviously a disconnect between where the shares trade today and where it ultimately could be sold to an acquirer or a private equity buyer. But if you can't find the catalyst for change to arbitrage that discount, you could be stuck. And I think that's probably the most common failure that we've had over our firm's history, is that we find something that there's a disconnect between price and value, but we misjudge how rapidly the change will occur and it becomes quote-unquote dead money. But that's much preferable to me and I think our shareholders than waking up with 50% less capital because we've overpaid for something.
What are some of your top picks right now where that methodology is playing out for you?
Well, there's one that we like a lot. It's called Bill Barrett, ticker BBG. It's an E&P company. It's an oil and gas driller in the Piceance Basin in northwestern Colorado. The company is being swept down, in my view, with the natural gas price at about $2.50 per MCF. But what the market misses is they also produce what we call natural gas liquids, which are methane, butane, propane, ethane used in production of plastics. And those have a lot more value than people are giving them credit for. So if you do an asset valuation and you take the 1.3 trillion in reserves and apply appropriate discount rate for time and development cost, we think the shares today are around 29 or 30. We think they're worth in the mid-40s. But we think there's a disconnect because people aren't scratching below the surface to see what else they produce. They produce oil and these natural gas liquids, not just natural gas.
This market is fueled
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to